Well, hello, boys and girls. Welcome to another scintillating, didactic, and provocative discussion of commercial law and ethics. Hopefully, all is well, is going uh, well for you today. All is well in Vermtown. It's a little gray today. Supposed to get a little bit of snow, but hey, we love snow, don't we? Well, today we are going to talk about bankruptcy. Bankruptcy! Good heavens! Of all the nations in the world, which country would you suppose has the highest bankruptcy rate? Wow, you bet. It is the United States. We get to have one bankruptcy for every 200 Americans. That's a lot. Even His Eminence, the President of the United States, has had not one, not two, not three, but four bankruptcies in his business career. So, why should you be interested in bankruptcy? Well, because whether you happen to be a creditor or a bankrupt petitioner, over the period of your business career, in just about every profession, you're going to come up against bankruptcy. And so it's important for all commercial law and ethics warriors to be familiar with the bankruptcy process and what's involved in it. So we begin with asking ourselves the fundamental question. So what's the point of bankruptcy? It is rehabilitation or liquidation of the debtor's assets, and then, of course, working through to try and have a fair disposition of those assets among creditors. So, is bankruptcy fundamentally a state or a federal process? What do you think? Well, it in fact, under the Bankruptcy Abuse Prevention and Consumer Protection Act of 2005, it is a federal process that is, of course, administered in all 50 states and the District of Columbia in Puerto Rico. So, as 13 years ago, when the Bankruptcy Act was updated, it was transformed, if you will, from a debtor-friendly process to what is now considered by many to be a creditor-friendly process. So, what is it that bankruptcy is trying to accomplish? I think we can agree that from the bankrupt's point of view, the bankrupt is trying to preserve as much of their property as possible. Certainly among creditors, division of the debtor's assets between the debtor and creditors is a goal. And then, of course, to divide the debtor's assets fairly among the creditors themselves as to who gets what is obviously an important objective. So I'm going to walk you through the bankruptcy process so you get an idea what the procedures are like, what the protections are like, and what the requirements are like. So we begin first with what we call a Chapter 7 bankruptcy petition. A chapter is like a section of the bankruptcy federal code. A Chapter 7 bankruptcy, for the most part, is a voluntary petition that is filed by a debtor who is referred to in the business as a bankrupt, that lists the following items. Now, it's very important to list each of these items because if you don't do that, especially with respect to debts, anything that is not listed on the bankruptcy petition is considered outside the bankruptcy. So, the debtor is responsible for filing a list of all the debtor's debts. Any debt the debtor leaves off is still alive and well and can still be collected on by the creditor. Hence, there's an incentive for debtors, bankrupt petitioners, to list everything they've really got in terms of indebtedness. Debtors' assets, and this, of course, is always the interesting subject area that creditors are interested in. What are all the debtors' assets? What are the debtor's sources of income, and what is the nature of that income? And then, of course, expenses. What are the debtor's, expenses? And as noted here in our little slide, most bankruptcy petitions are voluntary, that is, that are filed by the petitioner. Now, as we're going to see in just a moment, it is possible to place a debtor into what we call involuntary bankruptcy. We'll discuss that in just a moment. Now, what's interesting to note is it's not necessary that a bankrupt petitioner's debts exceed their assets. In fact, they may have a cash flow problem. And so the best example I can share with you of that, of course, is 2008. Everybody from AIG to Bear Stearns to Merrill Lynch, Goldman Sachs, hey, take your pick. Their problem was that they were illiquid, not that their assets, that they didn't have enough assets to cover all their debts. The problem was they had a cash flow problem, and they were unable to transform their illiquid assets into liquid assets. And so it is possible that a debtor can find themselves in a situation where they've got plenty of assets, but they're illiquid, like real estate, and may not be able to liquidate them in sufficient time as to meet their indebtedness requirements. Another requirement, a first requirement here is that the bankrupt petitioner, the debtor, must earn less than the median income in a state, or the debtor cannot afford to pay back at least a little over $7,000 over 5 years. Otherwise, if they can do those things, or they have a median income that exceeds, or they have an income that exceeds the median income for the state of South Dakota, then they've got to file under chapters 11 or 13 that we'll talk about in just a moment. Now, when we're talking about an involuntary petition, which is filed by a creditor against a debtor, the creditor has to have an unsecured claim of at least $15,000 or more that the debtor is failing to pay when it's due. Now, if you've got 12 or more creditors, then you're going to need at least 3 of those 12 or more to sign the involuntary petition, certifying the above. If you've got less than 12 creditors, then only 1 is necessary, okay? Now, what do the creditors have to plead in an involuntary petition to this federal bankruptcy court? Well, either that a custodian has been appointed over the debtor's property 120 days prior to the bankruptcy petition, or, and this is the most common situation, the debtor is failing to pay their just debts on time. Now, when a creditor or a debtor files a petition with the bankruptcy court issues what's called a temporary order for relief. Now, what does the temporary order for relief mean? It is an order that goes out from the bankruptcy court to all of the creditors listed on the bankruptcy petition, instructing them to stop all collection efforts. That even includes a legal action to reclaim or foreclose on the debtor's property. So in other words, the order of relief requires suspension of all attempts by a creditor, any creditor listed on the list, from attempting to get anything from the debtor, because now the bankruptcy court is taking jurisdiction, if you will, control over the debtor's indebtedness, and as we're going to see in just a moment, the debtor's assets as well. So clearly seeking a order of relief, you've got lots of creditors who are obviously after the assets of the debtor, but the order of relief calls them all off, suspends their efforts. Now, clearly, once the bankruptcy court has an opportunity to review the bankruptcy petition, then if the court believes that the petition is merited, that is, that it's properly within the jurisdiction of the bankruptcy court, then the court will issue a permanent order following up on its temporary order, making the temporary automatic stay permanent. Okay? Essentially telling everybody, hey, the suspension is now going to be indefinite. The bankruptcy court is going to adjudicate all the creditors' claims and resolve the indebtedness disputes. What is a bankruptcy trustee? The bankruptcy trustee, more often than not, is a CPA who also has a law degree. The bankruptcy trustee is actually chosen at the first meeting of the creditors. Yes, the creditors have a chance to get together with the bankruptcy trustee to discuss the bankruptcy case. And it is the bankruptcy trustee who we're going to see assumes legal control over all of the assets of the debtor, and will ultimately, as we're going to see, make a decision as to who gets what. So, within 30 days of the bankruptcy petition being filed, the bankruptcy court is going to call a meeting of all the creditors who are going to nominate and elect a bankruptcy trustee who is going to handle the case. Now, bankruptcy is obviously a federal court. There's a federal court judge who supervises that. He confirms the hiring, or if you will, the election of the bankruptcy trustee. But the bankruptcy trustee doesn't work for the creditors that elected him. The bankruptcy trustee clearly works for the federal court and is, once elected, a federal official with all sorts of power we're going to see in just a moment. Now, at this meeting of the creditors together with the debtor, the creditors get to question the debtor about the debtor's assets, financial affairs, and any suspicions about the debtors concealing assets or income. So it's not unusual to have debtors try and hide assets by transferring them to friends or family, or concocting wild stories. So one of the favorite ones I've heard is the debtor has cashed out all their assets into cash, gone to Las Vegas, and lost everything. And so there's no, records of having spent the money, and so forth and so on. Well, this is where creditors hire private investigators to determine, what the debtor has been up to. Now, what's really important to note is that if the debtor is found to engage in bad faith or hiding of assets of any type, then the bankruptcy trustee has the power to kick the bankruptcy petition back and thus terminate the bankruptcy proceeding, which now leaves the creditors free to resume their efforts to collect, foreclose, and otherwise seize property that the debtor has. So again, the debtor is required to act in good faith, and if they're found to be acting in bad faith, like concealing assets, then bad things are going to happen to them because they'll get booted out of bankruptcy. So bankruptcy requires good faith on the part of all parties, especially the debtor. So what's involved in the administration of a bankruptcy estate. And so I recommend this is something you may want to consider as, to be a bankruptcy trustee, as we're going to see in just a moment. When the assets are distributed, the bankruptcy trustee gets paid up front. He's at the top of the list for getting paid, as you're going to see. So bankruptcy trustees do very, very well. So it's something you may want to consider if you're going to get your CPA and law degree. So what's involved? Well, it is the trustee who's been elected by the creditors who's responsible for collecting all the assets that are legally required to be liquidated for the benefit of the creditors, okay? So, he's the one that, will serve orders on the banks and any other entity that has assets that belong to the debtor, transferring control and disposition of those assets to the bankruptcy trustee. The question arises, well, what about new property that is acquired by the debtor after the filing of the bankruptcy petition by the debtor? So let's say an inheritance, for example. What happens to that inheritance? Or what about income from a new job? Well, new income that the debtor has lawfully and properly received after the filing of the bankruptcy stays outside the bankruptcy and does not become part of the bankruptcy estate. So it's not subject to being distributed to the creditors. The trustee, the bankruptcy trustee, a federal official, he separates the exempt from the non-exempt property for creditor distribution. He also goes out and recovers improper property transfers, not only concealed property, but any preferential payments that the debtor may have made within 90 days of the petition. So early payment of some creditors to the detriment potentially of others, that those funds can be reclaimed by the bankruptcy trustee. So let's take, for example, this Jackson Holiday furniture case. I think this is a case that demonstrates the effect of an order from the bankruptcy court to all creditors to cease and desist. We have a situation where there is a debt that the furniture seller is seeking to collect on. And the question before the court here is, did the creditor violate the automatic stay provision of the bankruptcy code? And if so, what's the penalty? Well, the court did find a violation of the stay. The creditor continued to attempt to recover the debt from the debtor, even though they had received an order to stop all collection efforts. And so as a result, there were penalties that the creditor had to pay for violating the court order. So when you get one of these stays from the bankruptcy trustee or the bankruptcy court, hey, it's the law. You have to follow it even though you don't like it. So what is exempt property as opposed to non-exempt property? There are some types of debtor property that are not going to be subject to distribution to creditors. So for example, a debtor's residence. Now you got to follow me on this because it's a little complicated, but this is the rule. A debtor's home equity up to a federal limit of almost $23,000 or the state homestead exemption is can be exempt, providing the debtor has lived in the state 2 years prior to the filing of the bankruptcy petition, and he's limited to a maximum exemption of $155,000, almost $156,000 for a home acquired up to 40 months before the bankruptcy. So you can see Clearly, if a home is valued and can be sold for more than 156,000, then it will be sold, and the bankrupt petitioner will get this amount of money with which to buy a new home or rent housing. Unmatured life insurance, Social Security, welfare, alimony, child support, and certain types of benefits. So let's take, for example, our friend O.J. Simpson, who was a Heisman Trophy winner, played football for USC and also the Buffalo Bills professionally, was accused of murdering his wife. While he was acquitted in criminal court, he was found guilty in civil court and had something like $2 million judgment against him. So he had to sell everything to include his multi-million-dollar home, his Heisman Trophy statue, and whatnot. But what about his NFL pension? His NFL pension was exempt because it's a pension, and under the bankruptcy code is not subject to creditor claims. So what constitutes a voidable preference? If the debtor has paid a creditor cash that would otherwise end up in the bankruptcy estate, the trustee has the ability to void that preference. Liens. The debtor grants a creditor security interest in his property. Guess what? The creditor normally would get that unless there's something wrong with it, and then the bankruptcy trustee has the ability to void that if it's improper and if it should have been in the estate to start with. So, preferential transfers, the types that can be voided by the federal bankruptcy trustee. Certainly, a transfer that was made to a creditor to pay an existing debt that the creditor is receiving more than he would through the bankruptcy process. We've got a little cheating going on there, hence the reason why the trustee can void preference. The debtor's liabilities must exceed the assets at the time of the transfer, and the transfer must have occurred at least 90 days before the bankruptcy petition was filed. So you can see this rule prevents cheating by the debtor. Fraudulent transfers made within 1 year of the petition may be voided if the purpose was to hinder, delay, or defraud creditors. So sometimes things don't surface or become known until you're well into even outside the bankruptcy process, in the sense that you may have already made a distribution and then, hey, we just discovered there was a fraudulent transfer. Well, that's a voidable preference that the trustee can go after in order to seize it and pay creditors. Now, under Chapter 7, if we have a debtor who is in business and making ordinary payments in the course of the business, like to suppliers, utilities, mortgages, things of that nature, those are ordinary business indebtedness payments, and the trustee cannot or does not void those that are made in the process of business. So let's talk about, how does a trustee make creditor payments? How does he do this? And this is why CPAs go to law school, to learn the code, the bankruptcy code, and the process. There is, if you will, a bankruptcy code hierarchy of who gets what. Okay? So let's start first with secured creditors. Now, secured creditors, let's take a bank, for example, that has a mortgage on property, a commercial property of a debtor. That property, that secured property, will go to the creditor who is holding the security interest in that property. A automobile loan creditor would have the right to receive the automobile that it has a security interest in. So you can see secured creditors get to keep the value of the collateral up to the, or get to foreclose, if you will, or get to have the property up to the ceiling of the debt. Now, assume for the moment, let's say we have a bank that forecloses on a on the home of a debtor, then less first the exemption value. If the value of the home exceeds what the debt is, then of course the debtor would receive that difference. After we've taken care of secured creditors, now we move to unsecured creditors, if you will. So the very top, if there's any alimony or child support owing, that's not number one. You don't see that all that often. But here's where the bankruptcy trustee gets paid up front. The administration expenses for the bankruptcy, including the bankruptcy trustee and his fee, have to be paid before all of the unsecured creditors get paid. Oh boy. Yum yum. GAAP expenses incurred in the ordinary course of business between the bankruptcy filing and the granting of the order of relief. Unpaid wages, commissions earned within 180 days prior to the bankruptcy petition, up to 10 Gs per employee. Unsecured contributions to employee benefits up to 180 days before filing with a $10,000 limit per employee. Consumer deposits, taxes due government units, and drunken injuries. Okay, this is the order of creditor payments. Unsecured claims get paid pro rata. So what does that mean? According to a percentage in the class. So if you only have enough funds to pay 5% of the claims, then every claimant in the class, unsecured creditor class, for example, gets 5% of its claim. Now, what does the debtor get after all this? Well, the debtor gets what's called termination or discharge of indebtedness, which means all the creditors listed on the bankruptcy petition may not resurrect or continue in any way, shape, or form to seek repayment by the debtor. In other words, the debts expire. What is a non-dischargeable debt? Well, boys and girls, this is a debt that cannot be discharged in bankruptcy. So let's go through the list. Claims of federal, state, and local income taxes due within 3 years of the petition can't be discharged. You still owe them. Money that has been obtained fraudulently. So clearly, Ken Lay, the deceased CEO of Enron, Jeffrey Skilling, the president, Arthur Fasto, the CFO, were all sued for fraudulently, taking money, receiving money from Enron. Clearly, stockholders, employees that had Enron shares in the 401k sued these folks for obtaining money fraudulently. So even though they all went into bankruptcy, you can't discharge these types of debts. A loan of more than $500 used to purchase luxury goods within 90 days prior to the order for relief granted. So some people like to run out before they file bankruptcy and take their credit card and run up all sorts of debts to buy luxury goods. Guess what? Not going to be dischargeable in bankruptcy. Debts that aren't listed on the debtor's bankruptcy petition schedule. How about this? Money stolen through fiduciary duty obligation. Who are fiduciaries? So, for example, all employees are fiduciaries. So if you have, theft of funds, oh baby, you're still going to remain liable. Alimony, maintenance, and child support are not dischargeable. And then, of course, debts related to intentional or malicious injuries, i.e. tort suits, are not dischargeable. So your found to be liable for running over somebody with your car and you owe $1 gazillion, guess what? Can't discharge that award, that tort award, in bankruptcy. You're going to have to continue to pay. Fines and penalties owed to our friends at the government. Liability for injuries incurred while under the influence of drugs or alcohol, not dischargeable. Liability for breach of duty to a bank. Debts stemming from violation of securities laws. Oh, we've seen that before. And here's my all-time favorite at the bottom of the list: government student loans. Unless you can demonstrate a real, serious, major, ginormous financial hardship, you're not going to be able to discharge government student loans through bankruptcy. So what's our Kelly versus finance company case? Well, we have this couple, one parent who's working at this elementary school and the husband's working remotely from home. They've got these college debts. Their health care plan required, and they had a child who had a serious medical problem, which required the husband to work from home. The total family income was $70,000, but their combined student loans were $160,000. So they filed bankruptcy, claiming, of course, that they were suffering a severe financial hardship. Did the court find that they had a severe financial hardship? No. They said, look, unless a debtor is able to demonstrate they meet all three prongs of what's called the Brunner test, the debt, the GSL, is not going to be dischargeable. So what is the infamous Brunner test? The test requires that the debtor can't pay, cannot maintain, based on their current income expenses, a minimal standard of living for herself and her dependents if forced to repay the loans. Second part of the test, additional circumstances exist that this state of affairs is likely to persist for a significant portion of the repayment period. And lastly, that the debtor has made good faith efforts to repay the loans. Well, the Kellys here failed to demonstrate the first prong of the Brunner test, and that they've not adjusted their lifestyle based on $70,000 a year to demonstrate undue hardship. They indicate they would only have to reduce their expenses $374.88 per month to repay their student loans in full. So while the Kellys' food expenses are $800 per month, a thrifty food plan for four is only $550.65, used by the bankruptcy courts to determine a debtor's necessary food expenses. Bottom line, it's real hard to discharge government student loans in bankruptcy, as you can see. So, circumstances do exist that could prevent, discharge of debts. So certainly under Chapter 7, that section only applies to individual debts, not business organization debts. So let's take, for example, airlines or any publicly traded company, for example, can't be discharged through Chapter 7. We're going to see that they can be discharged under other chapters. So note that you can only file for bankruptcy once every 8 years. So President Trump, who has filed for bankruptcy 4 times, we're talking like every time 8 years goes by, he's filing for bankruptcy for one reason or another. As I mentioned earlier, courts can revoke discharges within 1 year if fraud or concealment is discovered on the part of the debtor. And as I mentioned earlier, a bankruptcy discharge can be denied altogether if bad faith or dishonest behavior, like hiding assets, is discovered. Now, here's something you have to watch out for. It's called reaffirming a debt. If a debtor reaffirms a debt, then guess what? The debt is revived outside the bankruptcy. Let me give you an example. I had a client once lovely old lady. Her husband was dying of cancer, and so they racked up a gazillion dollars in medical bills. Well, after he died, we put her through bankruptcy because she obviously couldn't afford to spend these hundreds of thousands of dollars of medical bills. Well, unbeknownst to me, some months later, she, gets a guilt complex and starts paying $50 a month to the hospital. It revived the hundreds of thousands of dollars of medical bills. So I had to go on my hands and knees and beg the hospital to waive this because the poor lady, she had this guilt complex, but she had no ability. She'd be paying $50 a month until they died, which initially is what the CFO at the hospital told me, and I finally was able to get higher ups to waive it. But if you start repayments in any amount, you're going to revive the entire debt. So that's a no-no. Here's a case of a debtor, who bought this truck and he wanted to keep this truck, but he, owed more on it than what it was worth. But he wanted to continue paying on this thing because he loved this truck. And the question became, well, will the court approve a reaffirmation agreement that shows a negative monthly budget? Well, no. Courts won't approve reaffirming, so he couldn't keep the truck. All right, we're moving now from Chapter 7 to a Chapter 11 bankruptcy. This is, and this is the operative word, a reorganization, not a going out of business process. Chapter 7 that we just finished reviewing is a going out of business section of the bankruptcy code. Chapter 11 deals with continuing the business by an individual or a corporation. So what the debtor is trying to do is to seek temporary protection from creditors while the company goes through a reorganization process. So let me give you some examples. Northwest Airlines was the first airline to go into bankruptcy, followed by United Airlines and Delta. The only airline that didn't go through a bankruptcy during this time period was who? Southwest. Only ones that never did go through bankruptcy. So what's the Chapter 11 process? Can be, like Chapter 7, either a voluntary or involuntary petition. There's an automatic stay issued to all the creditors, just like we saw with Chapter 7. There's a creditor committee appointed that can consult with the debtor and the trustee to design a repayment plan. Now, a debtor in possession, a DIP, is what most businesses use. Because let's take the airlines, for example. They remain in the business of flying high, and the debtor remains in possession of the company. But there always is a trustee, who sometimes is referred to as a receiver, who supervises, if you will, the business operations. So we had one company, Northwestern Utilities, that while it was a DIP in bankruptcy, the board of directors authorized themselves the payment of $1 million in bonuses. $1 million in bonuses and you're in bankruptcy? Well, the trustees said, no, 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 directors, that's a no-no. And so he disavowed that payment. Now, in Chapter 11, it's possible for the bankruptcy trustee, representing, of course, the bankruptcy court, to strong-arm, that is, force the creditors to accept a repayment plan that they don't, agree with. So let's go back to my good friends at the airlines. The airlines proposed shifting their entire pension benefit debts from paying those into the employees' 401k accounts shifting that to the federal government pension guarantee corporation. They also wanted to break, and did, all of their labor contracts, so forcing the labor unions to accept lower wages and benefits. And you can imagine creditors objected to that. Well, at the end of the day, using its strong arm authority, the bankruptcy court imposed those changes and reductions on the creditors. The bankruptcy court, like Chapter 7, can void any obligation or property transfer that the debtor in possession agreed to previously, like labor contracts, right? The reorganization that the debtor is supposed to come up with, has got to provide a specific strategy and financial plan for emerging from the financial distress. Now, poor United Airlines was in bankruptcy like 5 years, which is very abnormal. And they had to get all sorts of exceptions to do that. But finally, the bankruptcy trustee said, enough is enough. We're going to boot you out if you don't resolve this and come up with your plan, your final plan, within 30 days, which ultimately United Airlines did. Now, what are the rules? The debtor in possession's got exclusive right during the first 120 days, so the first 4 months of the chapter filing, to submit. They alone can submit a reorganization plan. And then if the bankruptcy court approves it, it becomes binding on all of the creditors. Now, what must the debtor do? The debtor has to submit a reorganization plan and payment plan for the creditors to vote on. That lists all the classes of claims, secured and unsecured ones, treatment to be afforded each of the classes. There's supposed to be an adequate means for execution and partial payment to the creditors. But of course, that's in the eye of the beholder, right? Creditors have the authority to reject the debtor's plan, but the bankruptcy court has cram down powers, the strong arm authority that I mentioned. And then, of course, discharge, once the plan is confirmed by all the indebtedness, is covered by the bankruptcy. Our Fox case here, shows a judgment that was obtained against Fox for fraud. So Fox files for bankruptcy, trying to get out from under this judgment of $2 million. Fox, in the bankruptcy plan, says that under Chapter 11, he proposes that all his creditors will be paid in full after 5 years. But to ensure his reorganization plan was feasible, he hired a CPA who reviewed the financial statements and provided an expert opinion that the plan was feasible. Only 2 of the 6 classes of creditors rejected the plan. The question before the court was Fox's reorganization plan feasible and fair? And if so, should the court impose a cram down? And the court said yes on both questions. What is a small business bankruptcy? A small business bankruptcy under Chapter 11 is one involving less than $2 million in debt. Now, why is this special? The debtor has the exclusive right to file a plan within, if you will, 6 months, and the bankruptcy court must confirm or reject the plan within 45 days of the filing. So, as you can see, this is a quick way to resolve a bankruptcy situation if your debts involve less than $2 million. This brings us to Chapter 13. Chapter 13 is available only to individuals, not businesses. The Chapter 13 debt can exceed $360,000 in unsecured claims or a little over $1 million in secured debts. It follows the same process as Chapter 11. Creditors can't use Chapter 13 for an involuntary petition. They have to use Chapter 11 for an involuntary petition. The debtor under Chapter 13 has got to file a plan within 15 days of the bankruptcy petition being filed, addressing future earnings to pay off all the debts. And that's the plan here under Chapter 13. Everybody gets paid in full the promise to pay all unsecured and secured claims in full. So we're talking, the slow dime as opposed to the, quicker nickel. Treating all remaining classes equally. While creditors have the right to vote on the plan, the court provides an opportunity for the creditors to voice their concerns at a hearing. The plan has got to be, the reorganization plan has to be completed within 3 years, or it can be extended like the airlines to a maximum of 5 years under Chapter 11. So what is discharge? Discharge is all indebtedness is terminated. And here's our last case for today, where we have this individual who's filing a petition under Chapter 7. Even though he disclosed that he was the sole beneficiary of a trust that owned a house in Maine, he lied when he listed the value of that house in Maine as zero. He also lied about transferring any property during the prior year. He had given it for free to the trust 7 months before filing for bankruptcy. He also lied when he said he was not entitled to a tax refund, when in fact he knew the IRS had sent him a check in the mail for 8,700 beans. So once he learned the bankruptcy trustees were going after his Maine property, he filed notice he was changing his filing from Chapter 7 to Chapter 8. The trustee and creditors objected. They claimed that the debtor had acted in bad faith. What do you think? And should not be permitted to convert from Chapter 7. The bankruptcy court and appeals court agreed. And the question is, hey, can the bankruptcy court refuse to allow a debtor to switch from Chapter 7 to 13? And the court said, hey, yes, the court can refuse to do that, especially where we have the bad faith exception. Okay? Well, boys and girls, that was a 2 or 3 credit law school course in bankruptcy. So now you are bankruptcy warriors. I expect you to do exceptionally well on the quiz on this one, because this was an especially brilliant discussion today, was it not? Well, stay well. Stay in touch. We'll see you next week. Bye-bye, gang.